Good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Just a quick check-in. Brent crude is at just shy of $110 a barrel. TTF gas is just over 100 euros a megawatt hour. In MMBTUs, that's about 32 US dollars per MMBTU, still 4 times higher than the price in the U.S., though we've seen a rally there recently. Carbon is just flirting with 90 euros a ton. So we continue to see elevated commodity prices. And off the wire this morning, we saw a development here in Europe where the European Union is talking about an exit from Russian crude flows within the next 6 months. With refined products coming within the next 12 months. So first, I want to kick that context off with Salih Yilmaz. Salih's one of our senior oil and gas analysts. Salih, what do you make of the EU decision-making, and how do you think it's going to affect oil markets as they come to terms with it?
Sure. Thanks, Rob. So I think this is quite significant news that we got this morning, and Brent close to $110 a barrel this morning means it's up more than 4% on the news. So it's quite significant, and what the EU is proposing is an orderly phase out of Russian crude oil over the next 6 months, and I think orderly there means that this obviously cannot and will not be overnight, and refined products by the end of the year. And I mean, what this is it would be a complete ban on Russian oil, seaborne and pipeline crude and refined oil, which is what the European Commission President Ursula von der Leyen said this morning. And the thing is, I mean, I'd like to remind everyone that we haven't really had direct sanctions on Russian oil, and what we have been worried about was more self-sanctioning by European refiners and by other European companies. But to be honest, as we've realized over the last few weeks, is that Russian oil exports have actually been quite resilient. And what this would mean is that there would be less workarounds for European companies around this new package of sanctions. And in this new set of sanctions, some countries that have initially been kind of saying that they would veto such an embargo, such as Hungary and Slovakia. I mean, these are countries that would that are a lot more reliant on Russian crude through pipelines. They will, in this instance, get an extra year to comply with these sanctions. So, I mean, I think the big question here is what happens to this Russian oil. What we've seen already without direct sanctions on Russian energy is kind of the redirection of some of the Russian barrels. Obviously, countries like India and China have been kind of procuring a lot more Russian crude at discounted prices. I mean, what we hear is that India has actually bought more Russian oil so far this year than all of last year. So India, I mean, in the near term, India could be a winner out of this if they manage to get more discounted Russian crude. And obviously in Europe, as they get less crude from Russia, they have been getting a lot more crude from the US. We have some refiners in Europe, like the Polish ones, that have already signed other contracts with Saudi Aramco, for example. So we will see more Middle Eastern crude come to Europe as well. So I think there will be an adjustment, a further adjustment in those crude routes as well. But I think at the end of the day, can Russia find a buyer even at a discount for all these lost barrels that it would have otherwise sold to Europe? I think the answer there is no. But I think in terms of the disruption that we see, that we've been talking about for Russian oil flows. I think we will see more of that. And it was interesting. BP CEO yesterday said that the drop in Russian output has so far been, as I said, quite resilient, but at around 1 million barrels per day. But he expects that number to be about 2 million barrels per day in May. And I think, given today's news, it would be safe to assume that that number may rise further towards summer.
Salih, assuming that number does increase, how easy is it made up for from other parts of the world? There's been ongoing discussion about how much more OPEC could produce, how much more Saudi Arabia, U.S. shale. I know OPEC's got a meeting coming up just tomorrow. What do they make of this entire macro environment, and how are they going to respond?
Sure. I mean, the short answer is that no, it wouldn't be so easy because, I mean, this is already a very tight market, which is something that we've been talking about for a while now. And, I mean, within OPEC, of course, I mean, there are a couple of member nations, especially Saudi Arabia and the UAE, with spare capacity that we know that they could bring back into the market. But we also know from the previous OPEC meetings that they have rebuffed calls to increase supply more than the monthly amount that's part of their plan. And by the way, I mean, you mentioned the OPEC meeting tomorrow. We do expect more of the same from this meeting. I mean, I think it will be another very quick meeting where they rubber stamp another modest 430,000 barrels a day of output increase for the next month, so for June. But I think it doesn't really matter what they really agree on anyway, because when we look at, I mean, we got some data for their April output numbers from a Bloomberg survey, and it looks like they didn't really increase supply at all in April. So, which again goes back to this point that except for a couple of countries, they can't really increase output anyway, and this follows years of underinvestment, and these majority of these countries really struggling to go back to their previous maximum capacity numbers. So, and by the way, I mean, when we look at the last month, it was Iraq that boosted output, so perhaps there is a little bit more spare capacity in Iraq. But then again, we always say Saudi Arabia could increase output, but even they couldn't last month. So I think we're in a very difficult situation for the oil market where there is this rising disruption risk from Russia, and we don't really have many alternatives to fill in that gap. And I should mention, I mean, one thing that could provide some support, provide some help to this difficult kind of tightness situation in the market is oil demand in China. I mean, with ongoing lockdowns in China, this obviously means some pressure on oil demand and oil demand growth, given how much oil China consumes. So this is one reason why perhaps we haven't seen the tightness get even worse in the market. But looking forward into the second half of the year, I mean, if this eases and then we get more disruption to Russian supply and we have even less spare capacity, then I think we're looking at a potential big dislocation between supply and demand for crude oil.
Okay, thank you, Salih. This is a good segue to bring on Patricio Alvarez, our gas and utilities analyst. Patricio, we just heard Salih walk through what's going on the oil side of the equation. In many ways, the gas market's even tighter, more precarious situation. Give us a sense of what's going on with the European gas market. Where do we stand on sanctioning gas as well? Is there a similar move here on the gas market?
Sure. Thanks, Rob. I think it's important to try and provide some context in terms of what are the two sort of outcomes that can come on the back of this oil embargo. So first of all, we think if it's on the European side's decision, they would try to extend or have an extended phase out of gas in Europe. If it was the European bloc's choice, this would probably be over the next 3 to 4 years. As it would take longer, given gas is just not as fungible as oil in terms of how it can be replaced, and just given the infrastructure constraints in terms of LNG import capacity, particularly in Germany, and just the structure of the pipelines and how these are mainly east to west bound transporting pipelines. With the exceptions, of course, of the UK and Spain and Portugal, perhaps, which are a bit better prepared to shift away from Russian gas in the near term. And then I think the other side of the equation is what happens in terms of what the reaction is from Russia to this oil embargo. For us, this could mean that there is more of a probability of a retaliatory cut to gas flows, given if you think about the impact that the crude embargo is going to have on the Russian economy, and particularly comparing it to a relatively lower impact if you were to cut gas supplies in terms of the proportion of GDP for Russia, it would have an outsized impact on the European economy rather than Russia. So we do see a risk of using gas sort of as a retaliatory geopolitical weapon. And thirdly, I think excluding all the geopolitical risk that we're talking about, gas storage levels in Europe have recovered significantly since the beginning of the year and now are tracking above 33% full. And that's broadly in line with the 5-year norm already. And this is thanks to an influx of LNG. And this is due to, as Salih mentioned, easing or temporarily weakening demand for LNG cargoes in Asia. And this is partly due to the lockdowns there.
Patricio, while you're talking about gas, the U.S. gas market's on an incredible bull run here lately. What do you make of what's going on there? I know that's not your backyard, but give us a sense. Are we seeing some global alignment there? Will U.S. continue to be its own sort of microcosm within the gas world?
Well, my understanding is that this is on the back of the LNG exporters. Sort of, this is the golden era for them to try and boost their profits on the back of this arbitration opportunity, if we may call it this, given that Henry Hub is trading at about I think $6 or $7 per MBTU, and if you compare that to the European prices, they are more closely aligned to 30 to 35. So sorry, is it 25 and 30 more or less? Anyway, there's a huge arbitration opportunity there, and this explains, at least to me, this sort of leaning of LNG exporters to favor European markets versus their internal markets, and this is what could be putting some pressure on gas prices in the U.S. as well.
Yeah, fantastic. We'll keep the theme of gas alive here for just a second, Patricio, and go over to Will Hares, one of our senior oil and gas analysts. Will, Equinor reported earnings this morning. You've got a focus idea on them that's highly contingent on what's going on with the gas side of the equation for them. So remind us of your focus idea and also give us a sense of how they did.
Yeah, thanks, Rob. So my focus idea on Equinor is really quite simple, is that the company is uniquely positioned as the second largest gas supplier to Europe after Gazprom. And this makes it, this really makes it a good candidate or exceptional candidate for cash generation on the back of Russia's invasion of Ukraine. We're seeing these incredibly tight European gas markets, and Equinor is the best position to harvest value from this scenario. We just saw them report averaged European invoice gas price in 1Q of about $30 per million BTUs, and this is one of the key drivers of their performance. The company's operations are also very strong, new well capacity, very high production efficiency, and they're also optimizing their flexible gas fields to maximize their exposure to the European spot gas price environment. And so this is quite clearly generating record financial results. We saw record free cash flow in the quarter of 12.7 billion. We saw adjusted operating cash flow of 20 billion. And so the backdrop meeting with the operational performance makes Equinor just an exceptional hedge to inflation, to Russia risk, and to European sanctions, which both Salih and Pat have just touched on.
Will, what do you make of the broader landscape? I not to put words in your mouth, but I think we're seeing record cash generation from the European oil majors. What are they doing with that cash? Where do they go from here?
So it's a good question, and the answer to this has changed quite sharply in the last 12 or so months, and this is as a result of rapid balance sheet deleveraging nearly uniformly across the group. We've seen net debt targets achieved, or gearing targets achieved as well, and quite comfortably, which means that their strategic objectives is now sort of pivoting towards distributions, really. And we're seeing this mostly in the form of buybacks. So we just saw BP upgrade their second quarter buyback tranche to $1 billion more than it did in 1Q. We just saw TotalEnergies at their first quarter results upgrade their buyback by $1 billion, up to $3 billion for the first half. We think these are probably going to also form a floor for sequential buybacks in the second half as well. There's significant headroom here as well from the free cash generation levels that we're seeing for further upgrades in the second half on the buybacks, also on the dividends as well, which management teams have been and boards have been quite understandably more cautious on upgrading and recovering after the major revisions made in response to the pandemic. But mostly what we are seeing continued very disciplined capital spending, which is driving this high free cash flow generation, which is being deployed into shareholder distributions, and of course an increasing share into the energy transition as well. We've been very clear for months now after Russia's invasion of Ukraine that we think this would be a major catalyst to accelerate energy transition plans rather than slow them. We are seeing no indication that this group is pulling back on the energy transition to redeploy capital into their legacy oil businesses. We continue to see indications that these ambitious renewable power targets are intact, and it's full steam ahead.
Thank you, Will. Given my coverage in the clean energy space, I pay a lot of attention to the kinds of spending that your companies are doing on wind and solar in particular. And there's a question in the chat related to hydrogen. So I think energy transition is a sort of catch-all for many different kinds of activity. So in terms of where they're actually spending money today, can you give us a sense of what that looks like, and how does hydrogen fit within that?
So hydrogen forms a pretty peripheral component of the European energy transition strategies. It's much longer term. It does exist, and each company has several hydrogen projects in the early stages, and details on these projects are not broken out in results yet. It's not a meaningful component of existing financial performance. But with that said, the indications from management are that the hydrogen market will be material in 10, 15, 20 years. BP has said they aim to meet 10% of global hydrogen demand by the early 2030s. So it is there. And I think partly as an energy transition hedge, we are seeing some investments being made, and some of the strategies are, I wouldn't say focusing on it, but are advancing on some projects. But I think it's important to note that the energy transition strategies that we're seeing from this group overwhelmingly are being centered around renewable power capacity, and mostly solar with that. So with the exception of Equinor, each European energy major's renewable power project pipeline is heavily weighted to solar projects over wind. The BP's is at about 80% solar.
Very interesting. Well, certainly most of the solar names have had a very robust 1Q for those that have reported so far. Wind names are struggling a bit more. With this in mind, I want to get Patricio to weigh in on the question of hydrogen as well. And for anyone who's not on Twitter, a lot of fun. All of us are on there. We occasionally share thoughts. Elon Musk weighed in on hydrogen and said he didn't think the world was going to go to hydrogen. He said that batteries were going to be the answer. So, Patricio, given that you've got your eye on the electric utility land, the gas land, what do you make of this hydrogen versus batteries debate? And we'll come back to you in a minute to get your thoughts as well. But over to you first, Patricio.
Sure. I think it's a good way to look at it is if you try and split the European utilities between electric utilities and gas utilities, and you can see the divergence quite clearly. Gas utilities, especially network gas transport utilities, are leaning towards a pivot towards transporting green hydrogen instead of gas. And then this has a strategic rationale of reducing the stranded asset risk associated with their gas pipelines. And it would also allow them to optimize what they already have as a business that could be similar in several ways. And there is some substance to the idea that hydrogen can help decarbonize the hard-to-abate sectors of the industry, especially steel manufacturing, as we've seen a lot of projects amongst the metal makers, producers as well. But I also have to, sorry.
Well, I was just going to interject. I have a question for you. How much gas hydrogen can you inject into the standard gas network before you start to sort of reach a limit? Because I know SNAM and some of the other companies have been talking about that kind of thing for a while. Any sense or update on kind of where that number is?
So at the moment, I believe the highest test is of a blend of about 10% at this time. But this seems rather conservative, with analysts in the sector claiming it could be up to a 50-50 blend. It's also important to note that about 70 to 75% of the European gas networks are believed to be hydrogen ready, meaning that there's very little capex needed into sort of adapting these networks for hydrogen use. And if I may expand on the side of the electric utilities, which are mainly generators and power grid operators, hydrogen has less room in their capex, and that's quite evident. As you mentioned, these companies, because they are electric generating, they'll pivot or try to push for battery storage rather than hydrogen. We can see that complementing their solar portfolios particularly, although let's say the scale of the capex for these projects is relatively small. Just echoing what Will said, these are still nascent technologies, both batteries and hydrogen, I may add. They probably represent less than 5% of most of European utilities' capex plans for the next 5 years. And some of them have highlighted there may be opportunities to accelerate growth, but this will not start until the middle of this decade, so around 2025, 2026.
Will Hares, I want to jump back over to you real quickly. What's your take on hydrogen versus batteries? Do any of the European energy majors even talk about battery storage? I mean, I know they're investing pretty heavily in EV charging infrastructure. Are batteries part of that discussion?
So I think the important thing to start off with here is that all the use cases are not equal. So you can't just throw batteries at any solution here. And I suspect that Elon Musk is talking his book in that he as the biggest owner of Tesla, he has a pretty big incentive to detract from hydrogen as a competitor to electric vehicles. I don't think that hydrogen is at risk of taking over electric vehicles, but I think what is an important use case for hydrogen is the hard to decarbonize sectors that Pat mentioned. So you're looking at steel, cement, chemical chains. These are also some of the top emitting industries as well, and they require very high heat in order to run. And I think batteries as a use case here is not viable. So I think there is a role for batteries to play. There's a role for hydrogen to play, and they are in very different use cases. So I would not be surprised to see hydrogen being deployed into heavy industry in order to decarbonize these very, very difficult to decarbonize sectors. And just quickly on batteries with the majors, it's not talked about really in any substantial way. I would note that there has been some small, relatively small M&A in battery technology made by a few. Notably, TotalEnergies bought a French battery company called Saft several years ago.
Okay, thank you, Will. Patricio, I want to come back to you real quickly to round out the discussion on 1Q earnings. Will presented a very rosy picture of what's going on for the EU oil majors. I think about half your names have reported thus far. What'd you hear about 1Q, and how's the rest of the year look in your view?
So I think one way to try and sum things up is just looking at the state of the power market in Europe, and it's mainly this extended volatility that we saw begin on the fourth quarter of last year, extended into this quarter amid Russia's invasion of Ukraine. We still see very elevated power prices on the wholesale market, and this continues to affect a lot of the utilities, especially their retail operations. But I think the theme moving forward will be how this market conditions will test the resilience of the integrated utilities in Europe, which so far have been able to mitigate the impact on the retail margin by turning to their globally diversified network asset bases, and also increased renewable capacity, which is broadly insulated from this volatility in power markets, given it's mostly long-term contracted via CFDs and PPAs. So is this it's this theme of utilities being able to weather the volatility and continue their investment growth, earnings expansion, with an emphasis on the energy transition.
Okay, thank you, Patricio. We've got a number of questions that have come in via the chat. I don't think we have time for all of them, but one question related to the oil market that came in, Salih, while you were talking about the sort of big picture evolution, what's going on with Russia. And the question relates to, what do we know about refinery flexibility? How easy is it to switch types of crude, and does it impact the demand picture? So I'll let you take a swing at that, and that'll probably be where we wrap up.
Sure. I think it's a very good question because, as you know, not all crude oil is created equal. I mean, this is something we talked about a month ago as well. I mean, there's light crude, there's heavy crude, there's sweet, there's sour. And when it comes to some of these refineries, I mean, they were a long time ago built to process certain types of crudes. And in this instance, I mean, as an example in the question, it's MOL. And this is one of the refineries that gets fed Russian Urals crude with the pipeline. So obviously it was built around this crude and it's configured as such as well. So, and this is probably one of the reasons why Hungary and perhaps this company wasn't a big fan of the idea of kind of completely stopping purchasing Russian crude and looking for alternatives. I mean, can it be done? I mean, of course, you can be looking at the Middle East or elsewhere in the world to buy similar types of crudes, but it probably won't be exactly the same, and it will not be as cheap. So, and obviously, if you are not getting the exact type of crude that you had the configuration for, then your output slate would obviously look different, and it may not look exactly like how you would like it to be. I mean, for example, now diesel crack spreads, diesel margins are extremely good. So not only MOL, but every refinery out there would be trying to maximize their diesel yield or just middle distillate yield in general. But then if you don't have the optionality of kind of getting the crude that would be the best for the refinery and the output slate that you have in mind, then that's not ideal at all. So, and by the way, thanks for the questions, Pancras. And I have noted down. You have a couple of other questions. I have noted them down. I don't think we have time to answer all of them, but I will. I will message you after the call.
Okay, thank you so much, Salih. For anyone who's here in London, tomorrow we have our ESG Investment Forum. It's an all-day event. It's the first event I'm going to be speaking at in over 2 years since the start of the pandemic. I'm going to be chatting about our outlook for European carbon allowances versus what we see for the oil market and what it's all going to mean for clean energy. It's going to be a fun discussion. If you aren't here in London, it is going to be broadcast online. So when we send the replay link for today's webinar here, we'll include the link for that for anyone who is interested. As always, I want to thank you for your time, and feel free to reach out to any of us on this call with any follow-up questions. We very much appreciate your business and your time. I hope you have a great remainder of your week. Take care.